Express this week, global markets rattled by the Iran-Israel missile crisis, breaking down the vulnerabilities inside the Middle East oil market. Stablecoins on sale in aisle 5, why Walmart and Amazon want their own digital currencies. It's a world awash in money, where the funds have been flowing this decade. A few good minutes at Chateau Fibonacci with the great JC Parets. Bring your own glass and the Investopedia indicator and what to watch this week. It's the Investopedia Express live from the New York Stock Exchange. Get on board.
Go.
Good.
Go ahead, Caleb.
Welcome back and welcome aboard to all our regular listeners and to all of you joining us for the first time live and in video. Here we are in video live from the New York Stock Exchange. Welcome to this new and hopefully improved version of the Investopedia Express. I'm Caleb Silver, the editor-in-chief of Investopedia and the host of the Express podcast. We've been doing this for a very long time, audio only, but now we are live on YouTube, live on Insta, live on LinkedIn. If you miss us here live, catch us on demand on your favorite podcast platforms. We're at the corner of Wall and Broad, where the buttonwood tree used to be, right outside the doors here. That's where the first stock trading began, and this is where it's been going on here since 1792. Right here at the New York Stock Exchange. They didn't call it the Stock Exchange until about 1834. Old building, old stock exchange, the center of capitalism, and these walls have seen it all. Now it's a global exchange with hundreds of billions of dollars flowing through it every single day, tons of products, and Investopedia is delighted to be here at the New York Stock Exchange for the Investopedia Express. Catch us every Monday. Again, if you miss us here, catch us on demand on your favorite podcast networks. This is a podcast and a show dedicated to educated investors like us who want to keep and stay smart about our money, about our portfolios, and stay on track to investing success. That's the Investopedia Express, investing success. So let's get after it. We got a market opening here higher to start the week after Friday's sell-off there brought on by the tensions between Israel and Iran. Those bombings continued over the weekend, the missile strikes over the weekend. That looks like it's intensifying, but investors are shaking that off today. Stocks rising out of the gate across the board, the major markets higher to get things going. The S&P 500 about 0.75% higher. The Dow Jones Industrials just under 1%, and the NASDAQ just over 1% higher. What's moving in the markets today? Looking at the Dow, we're looking at stocks like Goldman Sachs rising higher here. Also, IBM, International Business Machines, rising higher on the S&P 500. It's the chip stocks, AMD rising higher here, but also the casino stocks. A lot of the stocks that sold off on Friday coming back today. Defensive stocks and aerospace big on Friday. Those are selling off this morning to get things going. And on the NASDAQ, it's the chip stocks and Palantir rising higher to lead that index a little bit higher out of the gate. But when you look at what happened on Friday, we got to cite one of the classic Investopedia terms for what really went down. And we call that event risk, our term of the week. Event risk. Now, the greatest educational website for investors in the world defines event risk as the possibility that an unforeseen event will negatively affect a company, an industry, a security, the stock market itself, and cause a loss to investors. These are unpredictable, and event risks like missile strikes between countries, especially when oil's in the mix, especially in the Middle East, those can rattle markets. And we saw that happening last Friday. We saw gold spiking higher, of course. We saw oil spiking higher, 7 to 8%. We'll get into that in a second. And we saw stocks selling off. Well, not the case to start the new week. Investors moving on as stocks are moving higher. We'll get to our friend JC Parets in a few minutes, who likes to get us inside the numbers, because price ultimately is what matters when we're looking at the market. But let's dig in a little bit to this event risk brought on by the bombings between Iran and Israel, especially in the oil facilities. So those airstrikes did begin last week, right? We know that Iran is such a big producer of crude oil, one of the second or third biggest in the world, according to the EPI. And that Strait of Hormuz, which Iran kind of sits around near the Middle East, a very critical place for oil supply to flow through. So when you see missile strikes by countries like Israel into that area, you know that it's going to become a very sensitive place, and that is what moved oil higher, especially crude oil prices. Those were up 7% on Friday. Those are down about 1 or 2% today, even though those aggressions continued over the weekend. But you got to pay attention to what's going on inside the Strait of Hormuz. And there is a very particular island there, right there where a lot of the world's oil passes through. I was looking at maps from the EIA on that. About 14 million barrels of crude oil a day pass through there. 21% of the global liquefied natural gas in the world passed through it in 2024. A lot of that passing through Qatar, but it's a super sensitive zone. So when you have conflict there, that's what you end up seeing. And you got to pay attention to Karg Island. Doing some research at Platts and some other oil sites, oil research sites, about what's the most sensitive areas within the Straits of Hormuz. And it's Karg Island, this very small little island just off the coast of Iran there. That's the main hub for nearly all of Iran's oil exports. That's a strategic target. If you're looking to see what might be vulnerable in that area, look to Karg Island. And you got to also note that Iran's oil production has risen a lot in the last few years, and a lot of that oil goes to countries like China. So it's not as if this is an isolated incident happening right here in the Middle East. This affects everybody because it affects oil supply. And when you think about who Iran's biggest customers are, it's not the US. We got an embargo there. When you think about its biggest customers, it's China and its countries around the world that are depending on that oil. That's why this conflict is so sensitive. Again, due to sanctions, Iran has been selling oil to various partners around the world, and it has countries that buy it on a very small basis, small barrel of oil basis. Those are what they call teapots. These get a discount of about $7 per barrel. So a lot of sensitivity in that area around prices. But today, investors deciding that maybe it's not as vulnerable as it was last Friday, or maybe there'll be talks and discussions to ease some of those tensions. We see oil prices a little bit lower today, stocks higher, and that's how we are starting out the week. Let's move on to one of these topics that I've been fascinated with lately, stablecoins. Stablecoins, you know what those are. Those are digital currencies pegged to the dollar usually, or pegged to another asset on a one-to-one basis. Well, a story out of the Wall Street Journal last week telling us that major retailers like Walmart and Amazon, they want to launch their own stablecoins to handle transactions. Don't forget, they run billions and billions of dollars worth of transactions through their own networks every single week, every single day, and they don't want to wait for those payments to cross. So a story out of the Journal last week saying that Walmart, Amazon, Expedia, and other companies are now experimenting with launching their own stablecoins. And a lot of this depends on whether or not we get the passage of what we call the Genius Act. We talked about it on the podcast a few weeks ago. This is a law being proposed by lawmakers. It's actually bipartisan, that would allow for regulation around stablecoins to be used in our banking system. And they would actually have rules and regulations that would allow retailers to potentially use them as well. This has not passed the Senate yet, but it looks like it might. And then it would be signed by the president. And if we get a passage of the Genius Act, well, you're going to see stablecoins launched by not just retailers, but by other big businesses that handle payment transactions. Now, why do they want to do that? Well, they want to do it because these are faster settlement times. Typically, Walmart and other big retailers have to wait a couple of days before they get payment settlement and they actually receive payment for the goods that they've sold in their stores. This is a much faster and much more efficient way to do it. You hear the promise of the blockchain. Blockchain is where these stable coins will run. That's why there's so much excitement around it. But there's been a general broad excitement around cryptocurrency in general. I was at Bitcoin 2025 in Las Vegas. We know that there's a lot of money in that space right now, and that this administration is very favorable to the cryptocurrency industry. So keep your eyes on stablecoins again, and the Genius Act. That passes, that could become very interesting. And it all comes back to a lot of the activity in the sector right here last week at the New York Stock Exchange. Circle. This is Circle Internet Financial. This is a company that does a lot of stablecoin and blockchain payment systems. They went public here on the New York Stock Exchange. Shares were priced at $31, way above the range, which was $27 to $28, 25 times demand for that IPO. That stock soared in its debut, and we've seen a lot of action in the cryptocurrency and stablecoin market lately. You've seen a lot of momentum and a lot of money behind this sector. It's not just stablecoins that have the wind at their backs. Altcoins are making a comeback as well. Bitcoin stalled out a little bit at that $110,000, $111,000 per coin mark. We'll get into that with our friend JC Parets in a minute. But we see stable coins flexing right now as the passage of the Genius Act could be something we see in the next few weeks. And then we have digital currencies in our financial system. Favorite retailers are going to be using it. Those are the top stable coins by market cap. Keep a close eye on those. They trade very closely with the dollar because they are pegged to the dollar. But watch this space very closely. When you see a big IPO like Circle happening here at the New York Stock Exchange, see it oversubscribed, see a lot of activity in the sector, well, you know, something's brewing. Something is definitely brewing in Washington with the Genius Act. All right, coming up, we are going to get our good friend JC Parets, the founder of TrendLabs, in on the drop, and he'll drop in for a few seconds, tell us the most important charts he's watching, the most important assets he's watching. I've learned so much from JC over the years. I think you will too. Let's bring on JC Parets, the founder of TrendLabs.
JC, unmute yourself.
Hey guys, thanks for having me, Caleb. This is fantastic. I always tell you, you know, I used to read Investopedia.com in college, like preparing for exams 25 years ago or 23 years ago, however long it was. And, you know, the fact that we get to do this together, I mean, it's really coming full circle. Speaking of circle, see what I did there?
I see what you did there. Very, very smart. Well, I've learned so much from you over the years. You taught me that men lie with women lie, numbers don't. It's all about price. It's all about patterns and trends. JC has taught us at Investopedia and so many of our readers so much about technical analysis and charting, and so many others. You were the founder of All Star Charts. Now you're founder of TrendLabs. Tell us about TrendLabs. What's going on in this new world of yours, and what are you up to?
No, I appreciate it, Caleb. Listen, you and I know each other through All Star Charts. I was the founder. I mean, it started as a blog back in 2011, turned into, one of the most widely read technical analysis research on the planet. I mean, we're really proud of that. And that was a research company, still is, for hedge funds, professional investors, and individuals as well. And it's a research company. And TrendLabs is very much selfish to me. It's really about what I'm doing with my own money, with my own strategies versus, servicing other hedge funds and professional community. I'm really just talking about what I'm doing and then sharing that with everyday investors. So it's really a lot of fun. And I get to be more of me and less about what I'm doing for others. And focusing on growing my own, nest egg, if you will, and sharing those strategies is truly a blessing.
Yeah, well, the research is pure. I've learned so much from it, and folks, we'll link to it in the show notes, trendlabs.com. But let's get in to some of your recent notes, some of your recent observations. Stocks are up, you say, in a recent note, but the institutions, big institutional investors who really move the money around here, right? They are not positioned, as you say, as they should be. What's going on there? Why aren't big investors believing in this new bull market, Jason?
Yeah, I mean, listen, this is what TrendLabs is all about. It's about finding the divergences between what people think might be happening versus what actually is happening. And Caleb, you know that, sentiment is near and dear to my process. It's so important. And we are coming off some of the most extreme levels in pessimism in stock market history, depending on how you calculate it. And there's an unlimited amount of ways of calculating sentiment, but using a lot of data, a lot suggests that, people were more scared for longer than at any point during COVID or the great financial crisis or the bottoms of the post.com bubble. Like in any of those times, people were more scared for longer this time and still are. And something that I learned from a great mentor of mine, Mr. John Roque, is that, we're not in a reversion to the mean business, but we're in a reversion beyond the mean. And in other words, we're not just trying to get back to, normal levels and, an average. We tend to extend beyond that. And I have found in my experience that is particularly true from extremes. And I would tell you that this spring, the sentiment was at an extreme. And therefore, these are environments where we want to be greedy. We want to let our winners run. Mathematically, you can't have big winners unless you let them get there, Caleb.
Yeah. And that while they've been scared, the market has recovered some 20% now, almost from its lows here. So new bull market. But if you look at the NASDAQ, full bull market. And as you taught me years ago, there's always a bull market running somewhere. And if you look around the world, as we've been talking about on this podcast, I know you talk about in your research, bull markets throughout South America right now. If you look at Mexico, if you look at Brazil, if you look at Chile, but also in places like Poland, the money has moved out of the U.S. stock market to some degree, not all of it. There's so much money in this stock market, but investors have gone global for the first time and found some upside in other places. But again, it's that sentiment. It was as dire, as you said, as we've seen in almost generations. And if you look at consumer expectations for the future of the economy, they were as low as they were back in 1981, coming out of a long period of stagflation. But if you feel bad for too long, you could miss the rally. It looks like a lot of institutions may have done that. individual investors, JC, you know, we track those closely at Investopedia. They stayed the course, and a lot of them were buying dips in some of their favorite stocks, got rewarded for doing so. Stayed patient, bought where they thought where they saw good value, and a lot of them are a lot happier for doing so, despite the fact that the headlines are so negative. Let's get into commodities, because I know you track those really well. You taught me to always watch Dr. Copper. We've seen gold rally to record highs, a lot of that the safety trade, a lot of that because where else are you going to put your money right now? But now we got to see copper follow through. What are you seeing in the heavy metal and the soft metal space, JC?
In the same ways, Caleb, that we're seeing that sector rotation in the stock market, we're also seeing it in the commodities market. You mentioned the strength in equities in Latin America, for example, in Asia, and throughout Europe, 30% returns in Germany this year alone, just monster returns. But we're also getting rotation back into America. You mentioned the United States coming back strong. Technology is literally, as we speak, on pace to close at the highest levels ever, the technology index. So, you want to talk about sector rotation driving the bull market in equities. We're seeing the same thing in commodities, Caleb. It started with gold, right? The granddaddy of them all, right? Really making those moves, breaking out last year to new all-time highs when priced in US dollars. Remember, it was already doing that price in every other currency. So it was inevitable for it to happen in the dollar as well. We got that last year, and that has followed through this year. We've seen rotation into silver as well, platinum more recently. And so if gold is making new all-time highs, copper can't be too far behind. And sure enough, it's pushing that $5 level. And, I think is next to, really take off like gold. And then what would be the one after that, right? Is, okay, great. That's what's happening. So what's next? Historically, energy would be next. Energy, very specifically, in the S&P 500 represents only 3% of that entire index. Energy is 2% of the Dow. It is 0% of the NASDAQ 100. So investors in America just don't have exposure to energy, and I think they're really vulnerable. In the same way that pessimism in the equities market was at historic lows this spring, I think commodities are coming off a very similar kind of mindset, and American investors just don't own it, and they're very vulnerable. And the worst thing that could possibly happen to the American investor is a leadership regime in energy. They're not ready for it. I think that's the worst thing that can happen to them, and that's what we're betting on.
Yeah, and if they weren't listening to the campaign speeches of Drill Baby Drill, I can't help you there because we have seen a kind of a bull market getting started in the commodities area. But as you say, we're just not exposed to it because individual investors in particular, we all own the same stocks. We own the Mag 7. We own the top of the S&P 500. We ask our readers every 2 months, what stocks do you own? What stocks would you own for the next 10 years if you were buying and holding today? It's the same group of 15 to 20 stocks, maybe one energy stock in that entire group, JC. All right, let's talk about cryptocurrency. I know you track that as well. In a recent note, you say on TrendLabs, Bitcoin dominance has likely peaked. You heard me talking about stablecoins and the rise of stablecoins, but there's also altcoins. I'm not talking about the meme coins necessarily. Those come and go like fashion, as they say, but altcoins in general, and this Bitcoin dominance, this Bitcoin exceptionalism, this Bitcoin maximalism that I saw at Bitcoin 2012 in Las Vegas, that could be fading a little bit. What are you seeing in the charts?
Yeah, I mean, I think it is. And I don't think that that's a bad thing for the price of Bitcoin, by the way, right? So all Bitcoin dominance means is the value of Bitcoin as a percentage of all the value of all the cryptocurrencies. That's all that means. It doesn't mean that it means Bitcoin's going to go up or down. It's just what percentage of the pie does it represent? Bitcoin's right around 2.2 trillion and total crypto market cap is like 3.3 trillion. So it's about 2/3 of the total crypto market cap. And I think there's a very high likelihood that you're getting that rotation into Ethereum finally. And Ethereum is really the only one that matters at this point in terms of Bitcoin dominance because Ethereum's over $300 billion in market cap. The next one after that is down at 100 billion, which is Binance. Solana's at 90 billion, and then they go down from there. Ripple's another one that could eat into it potentially at about 140 billion, if I'm not mistaken. So I think that this is the last time. I think this is the last cycle where Ethereum will be such a large percentage. Because remember, Ethereum's larger than Ripple, Binance, and Solana combined, right? So I think it's the only one that could really eat into that Bitcoin dominance. So that Ethereum Bitcoin ratio is a big one now. I think in future cycles, Ethereum will be less needed for that Bitcoin dominance to decline, and therefore I think there's a really high likelihood that that's it. That's the highest you will ever see Bitcoin as a percentage of total market cap. I don't know, Caleb, obviously, but I think as investors, we need to think that that is a very high possibility. So act accordingly. And I think, what does that mean? We've been buying Ethereum. We've been buying Solana. I want to buy more on breakouts. I want to buy more on strength. If that thesis of mine proves to be true, I think it's got legs. And so we want to be adding to winning positions.
Yeah, we got some comments, I think, from some of the live watchers here from Liara. Very interesting. Would extra regulation have a negative impact on crypto value, though? Extra regulation, unless it's not favorable, probably shouldn't affect the valuation. But all I hear from Washington and from this administration is they're going to make it easier and easier for us to own cryptocurrency, to have stable coins in our financial system. They want America to be the crypto capital of the world. We know the president has his own meme coin. Everybody seems to be in the game over there. And now you also see the president's holding company launching a DeFi, decentralized finance company, as well as a crypto exchange. So I think they are a good question. We're going to see a lot more green lights for crypto, and that could mean higher prices depending on ownership. And I wouldn't be surprised, JC, if we saw crypto in our 401ks by the end of the year, at least Bitcoin, because they've been paving the way for that through the Department of Labor. All right, let's talk a little bit about key indicators you're watching across the broader markets. Let's look at equities. Let's look at the US markets here. What are 2 or 3 key indicators that you're watching closely to tell us where things are going to head from here?
Sector rotation. It's the lifeblood of a bull market. And you're seeing it, Caleb. You're seeing it. Financials, industrials have been massive leaders. And go back and study bull markets and bear markets in history. Financials and industrials leading is not a bad thing. People are like, oh, utilities and consumer staples. Yeah, they outperformed for, a few months. And if it was just utilities and staples outperforming, that would be one thing. But financials, industrials, and communications were right in there with them. And now technology literally today is making new all-time highs. This is technology, Caleb. And when you study every bull market in history, and I have, as you know, and I encourage everybody listening to do the same, you know what you're going to find in those bull markets? Technology is a leader. Technology is a leader, and technology is a big outperformer. And what are you seeing this entire bull market? You're seeing that. Now, it doesn't happen forever. Technology is going to take a step back and allow others to catch up, like financials, like industrials, like communications, even staples and utilities. Everybody gets a turn, Caleb, in bull markets. And so what do you want to look for? Continued rotation. That's what this is all about. Are more sectors participating? Are more industry groups participating? Are more countries participating, Caleb? And the answer is yes, yes, and yes.
Yeah, there's, as you say, there's a bull market running somewhere, and it's got to go from sector to sector and sometimes country to country. And that's what we've seen. You can look at the headlines and blame it all on that. The financial media is really good at that, present company included. But if you just look at sector rotation, where the money's been flowing and what's performing and not performing, it kind of makes a ton of sense. And these things are cyclical. All right. You are a sommelier. You're making your own delicious wine. You're also a master of sake sommelier as well. We got to get a wine recommendation from you on the way out. Looking for a good summer wine, JC. Something to have with maybe some grilled fish outside. Maybe we're making branzino with some nice roasted vegetables, good garden vegetables, something crisp, something light, something nice for summertime. Give us your best wine recommendation on the way out here.
Well, first, I'm not yet a sake sommelier. I am just a certified Japanese sake advisor. So I'm still one exam shy of the sake som, but I appreciate the love. Now I got to do it. So thanks. You want a good wine? So, listen, something refreshing like that, you wanted me to bring a wine. I had something bigger. It's not going to go with that dish though. It's going to be too overpowering.
Okay.
For me, for my taste, you're going to have something like that. That screams something like an assyrtiko from Santorini, right? Just classic, Greek. Your meal sounds kind of Greek, right? So that works for me, But then, the next day when you have the lamb chops, stick with the Greek theme, stay with the lamb chops. I would go north instead of the Greek wines, the Greek reds. For me, I like the Italian reds better. So go with a Bulgari Superiore. That's what you want, a Bulgari Superiore. It's going to be a classic super Tuscan, so you're going to get like some Bordeaux varietals in there. Man, to go with those lamb chops and some of that funkiness of that lamb, with the with that Brettanomyces that you're gonna get from those super Tuscans, the Italians, like they're not like strict with their structure like the Germans, where everything is so clean. The Italians are more like, hey, a little bit of this, a little bit of that, and that adds they're technically they're flaws to the wine, but a lot of us appreciate that for what they are, and it makes the wine even better. So shout out to the Italians.
All right, and the Super Tuscans, and shout out to you, JC Parets, good friend of Investopedia, the founder of TrendLabs, folks. We will link to his terrific research in the show notes, but go find it yourself, TrendLabs, and make sure you're following JC across the platforms. I've learned a ton from you over the years, and I expect to continue to learn more from you at TrendLabs. Thanks so much for joining the Express live from the New York Stock Exchange, our very first guest. Thank you for being with us, buddy.
Appreciate you, Caleb.
Coming up, folks, it is a world awash in money. We've been tracking money flows, not just for the past few months, for the past year or so, but since the beginning of the decade. And for the past 5 years, we've got trillions and trillions of dollars across capital markets right now. We're going to tell you where that money is and where it's moving. Money in motion coming up right after this. It's time for some money in motion, and we love to track money flows. We like to see where money is moving, not just on a daily basis, on a weekly basis, but on a long-term basis. And when you look across the capital markets, there is a huge amount of cash in the markets here. And then maybe that explains why they've been kind of resilient through all the headline risk here. It is a $247 trillion global capital markets. That is a massive amount of money when you think of it. When you think about where that money is and what countries have the biggest position across the capital markets, kind of opens your eyes a little bit as to why money keeps moving towards the stock market right now. It's again, 2.6 trillion in US assets alone. Out of that, $547 billion in foreign banks, U.S. asset foreign buying, 1.3 trillion of that is just in the stock market. This is just since the beginning of the decade here, since the beginning of 2020 till now. So much money flowing in, $350 billion of foreign investors buying into the U.S. stock market. When you look at the U.S. versus the rest of the world, about $1.3 trillion difference, $300 billion in international stocks. So we're in this period of time this year where foreign markets, as we just talked about with JC, have outperformed the US market. It doesn't happen very often, so capture this moment and remember it. And remember that where most of the money is in US assets. And in terms of money flows, 2.6 trillion flowing into US stocks in the last 5 years. That's the third largest inflows ever. And a lot of that we've seen just this year. So much money's been moving into the market, not all to the same places, but as we just heard, tech stocks, technology stocks about to make yet another record high. And we're seeing some other sectors catching up with that as well. We're also seeing a lot of money moving across cryptocurrencies, even though that's just a $3 or $4 trillion market. When you think about the entire size of the capital markets, talking about 247 trillion. So stocks and bonds really dominating the capital markets right now. There's a terrific graphic of what the stock market looks like. Public equity, the dark part of the bars right there, that's a huge part of it. That is stocks, global stocks, not just in the US, but Europe, China, obviously South America, and then it's fixed income. So really stocks get all the attention, fixed income, bonds rule the world, and then you have all these other asset classes that are being introduced to retail investors like us. But it's still dominated by the U.S. It's still dominated by stocks and bonds. It's still dominated by a ton of money flow moving into these sectors. So we like to watch the flows. You can watch them again on a daily basis, on a weekly basis. That tells you what equities might be moving, what individual parts of the capital markets might be moving. When you think about the entire picture, remember, it is really stocks, it is really bonds, and it's mostly US dominated, even though we're seeing outperformance from other parts of the world. All right, coming up, we're going to get you ready for the rest of the week, looking at what to expect this week in the stock market. Let's get set up for another really busy week ahead. They all seem so busy these days. That's because they are. But this week is going to be dominated by the Federal Reserve. We got an interest rate decision or no decision, or a decision to not make a decision coming our way probably this Wednesday when Fed Chair Powell gives his press conference after the FOMC meeting, which starts on Tuesday. We're also going to get retail sales on Tuesday for the month of May. How strong were those? On Monday, just a few earnings coming out this week. Lennar leading things off, and some manufacturing surveys as well. We're going to get some home builder numbers coming out on Tuesday as well. And then Wednesday, we'll get again that Fed decision from the FOMC, the Federal Open Market Committee. If you look at the CME's Fed Watch tool, which I look at obsessively, there's about a 0.1% chance that the Fed lowers interest rates at this meeting. There's a 100% chance that the president will not like that decision. And we may even hear more pounding on the table for a lowering of interest rates by the Federal Reserve from the president. And we may even hear that he's already picked his replacement for Fed Chair Powell, whose term expires, I believe, next May. So he's got a while to go. But if he announces who that Fed chair pick is going to be, who might replace Powell, if confirmed, you might have what we call a shadow Fed chair looming over the Federal Reserve, which might make things a little bit messy for the Fed going forward. But the Fed has been resolute. The data looks good. We got the inflation report last week. CPI came in right around 2.4%. We know the unemployment rate is at 4.2%, 139 or 137 jobs added last month. No reason to raise interest rates now. We got tariffs potentially coming our way. Those are going to be inflationary. So we probably won't see any moves on interest rates, but maybe one or two towards the end of the year and small ones. Let's look at a comment from our buddy, Dr. Preston Cherry. A lot going on this week in the markets and the economy. You said it, my friend, and a happy belated Father's Day to you. Tons going on. Hey, love the podcast. We love you. Thank you so much. Thanks for your comments. And can you get an internship? Yeah, I need one too. We will put that in the show notes of where to look. But thank you so much for tuning in. We want you to be joining this conversation live on YouTube, live on Instagram, wherever you're watching it live. And if you can't catch it live, catch it on your favorite podcast channels, audio only, when this is over. All right, coming up, it's the Investopedia Indicator of the Week. What indicator are we watching closely this week to give us a sense of where markets are headed or where the economy is headed? The Indicator of the Week coming right up. All right. It's the most boring yet the most important chart in all of economics. It's the Fed's dot plot, because when the Fed renders its decision on interest rates this week, we will get, like we do once a quarter, basically, the SEP, the summary of economic projections from the Fed. That kind of tells us where Fed governors, and 12 of them from their different regions around the country, plus the Federal Reserve Chair, Jay Powell, think the economy is headed in terms of economic growth, in terms of GDP, but also a forecast for how many interest rate cuts they think, or where they think interest rates were going to be going out 6 to 12 months. And it's called the dot plot. We only get it, again, 4 times a year. And it's the worst chart you've ever seen, but it's super important. And what's important to watch in that dot plot is this sort of lowering of interest rates, or where the Fed thinks interest rates should be. The Fed funds rate, that is. This is the rate at which banks loan each other money. And they think it's going to be lower, but not a lot lower than where it is today. So if you look at the Fed dot plot when it comes out on Wednesday with a summary of economic projections, maybe this dot plot will change. Maybe those dots will all be in a line and there's no interest rate cuts coming this week, according to the Fed. That could all change because we have tariffs. We do have a huge conflict going on in the Middle East right now. A lot can change, and you're probably going to hear more uncertainty from the Federal Reserve this week when they come out with their decision. So keep a close eye on the dot plot. Again, the most boring yet the most important chart in economics right now. So we did it live from the New York Stock Exchange. It's the Investopedia Express. Thanks so much for joining us. Big thanks to our buddy JC Parets for coming on the show, our first live guest here in our new video podcast live from the Stock Exchange. We'll link to JC's research and all the research we cited on today's episode. Again, if you didn't catch us here live, catch us on your favorite podcast network or on Investopedia.com/The Express Podcast. Watch us on socials. Watch our site. We got free news coming out for the educated investor. Our news team is going to be all over the Fed meeting, all over earnings this week, and all the reports you need to know. We will be back here next Monday, and we'll talk again a little further on down the line.